All right, so good morning and welcome to the Clean Fuel Tax Credit webinar that we're hosting today. Really excited to see folks here and excited to talk about this topic a little bit more. That is certainly a hot topic everywhere that I go these days, and is probably something that you all are talking about as well in your areas. I'm Ariel Kagan. I work for the Minnesota Farmers Union, and I lead our Climate and Working Lands program. Minnesota Farmers Union is a grassroots member-based organization, and we represent family farmers across the state of Minnesota. This issue is really important to us because we strongly believe that farmers should have a seat at the table when policies are being designed and developed. And this policy and upcoming additional clean fuel tax credit policies are going to have the potential to have a big impact on our farm economy. And so understanding how they're working and where there's room for influence in the coming months is a priority for us at Minnesota Farmers Union. I'm also really happy that we're co-hosting this with our partners at the Minnesota Soybean Growers Association, Minnesota Corn Growers Association, and the Minnesota Biofuels Association, and really want to thank Joe, Amanda, and Brian for their partnership on this webinar. There's a lot of expertise in this room, thanks to them. And I will pass it over to Amanda to give an introduction to herself and then pass it along to our other co-hosts.
Well, good morning. My name is Amanda Billick. I am the Senior Public Policy Director at the Minnesota Corn Growers Association. MCGA is a grassroots farmer-led organization representing nearly 7,000 Minnesota corn farmer members through various advocacy efforts, both at the state capitol as well as in DC through our policy efforts.
I'm Joe Smentek. I'm the Executive Director for the Minnesota Soybean Growers Association, the grassroots policy organization on the soybean side, working at the state level with corn and other partners, and then also at the national level with the American Soybean Association. I am Brian. Kick it over to you.
Hi, everyone. Good morning. Brian Werner, Executive Director of the Minnesota Biofuels Association. We are a nonprofit trade association representing the ethanol producers in Minnesota. We have about 9 plants throughout the state. So it's great to be here this morning and talk about this and to see so many friendly faces.
Wonderful. All right, so we are going to get into this. Share my screen. So, all right. So we're here on Zoom. Many of us spend a lot of time on Zoom, but just in case this is not a place that you spend all of your time, a reminder that this is a large call and we're really happy for that. So please keep yourself muted during the call, and you can find the mute button on the lower left side of your screen. And then we're going to be using the chat primarily for any questions that you have during the call. You can certainly put questions in the chat during the presentations, and if they're clarifying questions, I'll be monitoring those as they come through, and we'll feel empowered to interrupt a speaker and ask a clarifying question. But if they're more general questions or comments, we'll save those for the end, and we'll have some time for discussion at the end. So encourage you to use those tools. And what I want us to get through in this hour, and what I hope you will leave with after this time together, is a better understanding of a variety of the topics that are important to this issue around clean fuel tax credits. So we'll start off by talking about what exactly is sustainable aviation fuel and this whole 40B tax credit business. We'll also spend some time talking about carbon intensity, or CI, and how that's measured and why it's important in this context. We'll talk about the climate smart agriculture pilot that is part of this tax credit and what that means for farmers and what we're learning about in these tax credits with this pilot. And then we'll spend some time talking about the key considerations and challenges associated with this 40B tax credit and the upcoming 45Z tax credit. And then what comes next and how you all can help to shape these policies as they continue to be developed. So it's a good agenda and a lot to get through. And so with that, I will hand it over to Amanda to get us started.
Great. Thanks, Ariel. Well, I am going to provide just a little bit of context before getting into some of the specifics of the various tax credits. And, sustainable aviation fuel has become a very hot topic the last several years. And some of that is rooted in an effort by the Biden administration that was announced in 2021, which is the Sustainable Aviation Fuel Grand Challenge. And the focus really around this Grand Challenge has come from the Biden administration's priority for looking at how to address greenhouse gas emissions economy-wide. And in particular, this effort is focused on sustainable aviation fuel and aviation in particular. Aviation is a difficult sector to decarbonize. And so they led to sort of announce this SAF Grand Challenge, setting some specific goals for some benchmarks for the airline industry to be thinking about the blending of sustainable aviation fuel. The near-term goal for that Grand Challenge is 3 billion gallons by 2030, and then longer-term 35 billion gallons by 2050. If the aviation sector was able to reach that longer-term goal, that would essentially then result in an aviation sector that would be fully zero carbon. These goals also do give us a little bit of a sense of how large the potential market could be for sustainable aviation fuel. And that is where some of the interest comes in, because this could be another, new value-added sector, both for biofuel producers as well as farmers that would be supplying feedstocks for some of these different fuel types. And then just to look a little closer to home, so our airline that operates in Minnesota out of MSP with one of the hubs is Delta Airlines. Delta has set their own sustainable aviation fuel goal, and that is to have 10% fleet-wide SAF by 2035. They use at the MSP airport 250 million gallons of jet fuel per year. So if they were able to meet that goal, that would be about 25 million gallons for MSP. And then there's probably large fuel uses all other places across the country. And so this could be a large market demand for several of these airlines. Ariel, if you can go to the next slide. So next thing I just want to cover is to talk about some of the different technology pathways. I would, SAF is really defined as blending renewable fuel blending that renewable based fuel with a petroleum based jet fuel along a 50-50 blend. And there are really sort of three main buckets for SAF technology. The first would be alcohol to jet. This is where you would take alcohol feedstocks such as ethanol or isobutanol, and you would upgrade that into a hydrocarbon fuel. Gevo is a company maybe you've heard about that are working to scale up an alcohol to jet facility in South Dakota, which would use corn to produce an alcohol-based fuel. Right now, there's only one alcohol to jet SAF production facility in the US, and that is Georgia's LanzaJet, and they're using Brazilian sugarcane as their feedstock. The second bucket would be these hydroprocessed esters and fatty acids, or HEFA. This would be made from oil seed crops such as soybean or camelina, as well as used waste oils such as animal fats or even corn oil as a co-product from ethanol production. And then the third would be a Fischer-Tropsch process. This is a thermochemical process that could take something like wood waste or municipal solid waste and gasify that, which would then produce a syngas, and then that would be converted to a liquid hydrocarbon fuel. So the next slide, Ariel. So just to go over, there are two tax credits that we're going to be talking about today. These were included in the 2022 Inflation Reduction Act, and these tax credits were put in place to aim to help to increase the commercialization of sustainable aviation fuel in the US. So the 40B tax credit, that's the one that had the guidance that was just most recently issued in early May. And that tax credit and the Inflation Reduction Act is, it's scheduled to expire at the end of 2024. The 40B tax credit is really described, I would think of as like a sustainable or as a blender's credit. So this would be for the incentive for blending the sustainable aviation fuel. Given that there are not a lot of commercial technologies, there's probably not going to be a lot of utilization of this tax credit before it expires at the end of 2024. But both of these tax credits, 40B and 45Z, do set specific requirements for needing to reduce greenhouse gas emissions. For the 40B credit, it needs to be at least 50% compared to petroleum-based fuel. And then for the 45Z, which is a clean fuel production credit, which also could include sustainable aviation fuel, but it's not exclusively for sustainable aviation fuel. It could be other types of clean fuels. And this is really a clean fuel producer credit. that would flow to the clean fuel producer, the plant that is producing this fuel. Also having a carbon intensity reduction requirement as a part of those tax credits, which we're going to talk about in a little bit. And there are different levels for what the value of that credit might be, either going to the blender of the sustainable aviation fuel or the clean energy, the clean fuel producer, is the case with 45Z. So go to the next slide. And so when we talk about carbon intensity, which is central to both of these credits, carbon intensity is the life cycle measurement of emissions from a fuel, all the way from sort of at each stage of production and use. So there's two main life cycle models that can be used for evaluating these transportation emissions. The first would be a model that was developed out of the U.S. Department of Energy, referred to as the GREET model. And really, GREET has become and is the gold standard for really looking at evaluating life cycle emissions for a variety of transportation fuels. And they do this under a wells to wheel life cycle analysis. So looking at from the production of the feedstock all the way to when the fuel is used either in the vehicle or it's combusted or used in the airplane, as in the case with SAF. And then the other model is CORSIA. And I know Brian's going to get into talking about some differences in both of these models. But CORSIA is a European model. And there are some disadvantages in that CORSIA model for looking at evaluating crop-based biofuels. And so it's a good thing that both of these tax credits are going to be using the GREET model. They're going to be a modified GREET model in helping to evaluate and score these various clean fuels, including SAF. But it was a good decision that GREET is going to be the baseline or the baseline model for being able to evaluate and score this. But how GREET gets adapted for doing this for the different tax credits will also have an impact on the fuel producers as well as those who will be supplying the feedstocks for some of these fuels that will get produced. So I'm going to end there and then turn it over to Brian to get into a few more specifics of these credits and clean fuel production.
Great. Thank you, Amanda. So in understanding how we get to eligibility for these tax credits, I think it's really helpful to know where the ethanol industry is at today in Minnesota. So using the Argonne GREET model, this was put together by our national trade association, the Renewable Fuels Association, as an example of, on average, where an ethanol plant in the state of Minnesota might be using in terms of carbon intensity of the fuel they're producing in the state of Minnesota. So some plants might be a little bit above this, some might be a little bit below it, but on average, the total emissions that are associated with the production of ethanol in the state of Minnesota are right at around 53 grams per megajoule. So when I think about this, I like to think about it as a scale of 0 being net zero, and then 100 being generally where petroleum would be at. So right now, the production of ethanol in Minnesota is about 40 to 50% better than petroleum, and that's taking into account the emissions related to the corn production. So that's, seed, fertilizer, chemical, the use of farm machinery. And then that also includes what we call hypothetical land use change. And then so if taking all this into account, that also, about half of the emissions are in the corn production and about half of the emissions are in the ethanol production. So that's, energy usage at the plant, natural gas, electricity, but also that a lot of that is also tied up in the CO2 from the fermentation process as well, is included in the overall life cycle analysis. But one of the things I like to point out to folks on this one is because corn absorbs CO2 through photosynthesis, the tailpipe emissions are considered biogenic of ethanol. So next slide. So Amanda talked a little bit about the two different models that are allowed to measure the life cycle CI intensity of finished fuel. I like to think about this. I think a good metaphor is using a yardstick, right? It's like, what yardstick are we going to use to analyze the overall emissions when producing a fuel? So right now, the two tax credits, 45Z, you have to be under a 50 grams per megajoule life cycle in order to qualify for a tax credit. And for sustainable aviation fuel, generally you have to be somewhere in the 44.5 range because there's added energy in the processing of turning the ethanol into sustainable aviation fuel. That adds anywhere from 6 to 10 points of additional CI into the finished sustainable aviation fuel. So if baseline kerosene jet fuel today as an 89 CI score, then we go from there to, okay, what technologies are available to lower the CI score of the final fuel? So the GREET model right now, ethanol to jet, using cornstarch ethanol, the default is right at around a 70, and that includes about 7 points of land use change emissions. The main difference between GREET and ICAO is that the ICAO model assigns a significant penalty to liquid-based biofuels for what they're calling land use change emissions. So that's the idea that additional demand for biofuel will cause different changes in how land is used around the globe. So overall, using technologies like carbon capture and sequestration, using things like renewable natural gas at the plant, are tools that ethanol facilities are going to need to have available to them in order to lower their CI scores to such an extent that they will be eligible to claim these tax credits. And so that's one of the things that I think is really important in this conversation, is that because these tax credits are for the production of clean fuels, it is the plants themselves that are going to be the ones that are going to be qualified and being able to claim these tax credits. So to the extent that anything will flow to the farmer itself, that him or herself, is sort of contingent on the ethanol plant being able to get their CI score below these thresholds. Next slide. I think this was a helpful chart that the Renewable Fuels Association put together to sort of show the differences in the two models between the Argonne GREET and ICAO. And I think one of the things that has been a little frustrating for us as an ethanol industry is that in a lot of the media reports that we're talking about, whether or not the GREET model would be allowed for would be an allowable yardstick for analyzing life cycle emissions for sustainable aviation fuel, was that a lot of times it was described as, agriculture and ethanol want to weaken the SAF standards or make it easier for agricultural feedstocks to qualify. And I think this slide really shows, in truth, GREET is more credible and transparent and scientifically robust because it uses more up-to-date data and assumptions about crop and biofuel production. So a lot of the studies that underlie the GREET default values in the GREET model are from anywhere from 2021 to 2022, 23, and 24. And a lot of the studies that underlie the ICAO model are much older. They're from, anywhere from 2006 all the way up to 2012. So in our view, since analyzing things like land use change, emissions from land use change is a really inexact science, that using more up-to-date data about cropland usage and how it's being used around the globe, it definitely provides a better, more transparent, and more scientifically based overall life cycle score. Next slide. So I'll just be really brief with this one. So the 40B SAF tax credit, it's actually one of the interesting things about it is it was the first time that the GREET model was used in federal tax policy. So it's the first time a carbon model recognizes farming practices as lowering emissions in a finished fuel. So that overall, I think that is certainly a good thing. We're recognizing that the work that farmers are doing to sequester carbon in the soil is something that has a climate benefit and has a benefit to ethanol production overall. I'll defer on the climate smart agriculture pilot program. I know Joe's going to talk about that a little bit, but there are extensive certification and verification requirements involved with how you make sure that the tax credit that the practices that people say they're doing are actually doing those on the farm. And then importantly, I'll say there were only a few different technologies that were allowed to be incorporated into the modified GREET model for the 40B tax credit. So the technologies that ethanol plants are allowed to use in that model are carbon capture and sequestration, renewable natural gas, wind electricity, and this climate smart agricultural program. So interestingly enough, it did not include solar energy as an allowable activity. Anaerobic digestion from renewable natural gas was not included. If you're going to incorporate renewable natural gas, it has to be from a landfill. And there were other things at the plant level, like the use of combined heat and power and biomass power that were not included. So those are a couple of things that we're going to be working on for 45Z, is to increase the flexibility and increase the amount of technologies that plants are able to use in order to reduce their emissions to get below the thresholds for these tax credits. Next slide. So I'll be really brief on this too. These are some of the key challenges that the Minnesota Biofuels Association sees in this. So we need economically, socially, and technologically feasible tools for ethanol plants to reduce their emissions. We need policy and regulatory certainty. So, is 40B workable for growers and for plants in order to reduce their emissions? Will either of them be extended? 45Z starts January 1st of 2025, but only lasts through December 31st of 2027. So that's 3 years of tax credit. And, that doesn't leave a lot of time for plants to make these sorts of capital investments in order to see the return on those tax credits. And then there's also the uncertainty of there's an election in November. How will that impact whether or not these tax credits are extended or even repealed entirely? And then lastly, environmental permitting. So installing these new technologies at a ethanol plant, installing these new types of equipment that are necessary to reduce the CI score often requires Clean Air Act permitting through the Minnesota Pollution Control Agency. We did a study with the Minnesota Chamber Foundation recently, analyzing the timeline to get an Air Act permit in Minnesota versus some of the states surrounding us. And we found that the median time is 351 days, and the average time is 586 days to be granted a permit. So that is one concern, that if an ethanol plant is going to be installing new technology to lower their CI score to qualify for a tax credit, how quickly will they be able to incorporate those types of technologies into their Clean Air Act permits through the Minnesota Pollution Control Agency. So with that, I think that's my last slide. So then I'll kick it over to Joe, who's going to talk a little bit more about the Climate Smart Ag pilot program that was included in the 40B tax credit.
Yeah, thanks, Brian. As Brian mentioned, this is the first time that we've seen this acknowledgement that farmers can actually reduce the carbon footprint and have a good climate change message in some of these modelings, which was a great improvement. It was very forward thinking. We were very excited to see this included. However, a lot of our groups have issue with the way that it was included. As mentioned, this is a tax policy and a carbon model. Carbon model obviously based on science, based on hard data, some research, some modeling that can be tinkered with. Tax policy not based on science, but based on politics and using some levers on what we want to see done. So the way they laid this out for corn feedstocks to be eligible, you must use no-till farming, you must use cover crops on those fields, and you must have an enhanced efficiency nitrogen fertilizer plan. So you need to be looking at your fertilizer usage. You need to be following something like the University of Minnesota recommendation, some type of making sure you're ultra efficient with your nitrogen fertilizer. And then if all three of those practices are used on the entire field, you get a reduction of 10 CI points. It's an all or nothing approach. So while Brian mentioned some of the other processes that can go in, these three must be there in order to get that first $1.25 credit. If you're not doing one of them, you're not going to be eligible no matter what. So we heard Brian talk about his member plants. Some of them are a little bit higher, some of them a little bit lower on meeting this 50% reduction. If they're meeting the 50% reduction, even if they get to 75% reduction, and they're sourcing feedstocks that don't do these three things, they're not eligible for any of the credit, which is, I think where we have the biggest issue, because according to the farm CPA, Paul Niffler, there was about 50,000 bushels of corn that would qualify using all three of these practices. So, the limiting of this is really where we see the IRS policy part, not the science, being used in the carbon model. For the soybean feedstocks, similar, we already know for soybean feedstocks, we meet 50% reductions. The EPA has already called it an advanced biofuel with biodiesel, some of the other things. It already meets it, but in order to turn that switch and say, yes, you qualify, you have to do no-till and the cover crop portion. They drop the efficiency in nitrogen, obviously recognizing that you're not doing that on soybean fields to the extent as corn fields. So you still need to turn that switch, though. You still need to have both of those things, and then it gets a reduction of 5 CI points. That 10 and 5 CI points are based on a carrot and stick approach. They're not based on the science. You might be able to actually, in some areas with some soil types, you might get greater than 10 CI points in corn efficiency. You might get less. It all depends on the science, the field you're doing it in, the geography, all types of those different things. So this is really where we see the marriage of a political process with the IRS code and the science process with the carbon market, where we kind of get some things that don't make a lot of sense and don't recognize actually the good work that farmers can do. I think we're ready for the next slide. I thought there was one other slide. I'll just talk about these things. Sorry. Back to that other one. The other parts of the pilot project that are important in here to recognize is there are no double counting. If you're using these no-till farming and cover crops as part of another offset, if you've sold that carbon credit to somebody else, your feedstock may not be eligible. As Brian mentioned, there has to be certification. There has to be the producer of the SAF has to contract directly with the farmers for these specific practices, and there needs to be traceability with that to make sure that they can show that they are actually sourcing these things and following these procedures. That really where we're seeing some people being, I won't say preyed upon, but preyed upon by some outside groups that want to charge farmers to do this for them, to do the verification and show that you're doing X, Y, and Z. And they're only going to charge you, $5, $10 an acre, whatever it is, to do this certification and traceability for you. This is a plant decision. You know, as Brian mentioned, as Amanda mentioned, this is a refiner blender credit. This is not a farmer credit. So, you know, we talk about a producer credit. That's a producer of the fuel, not a producer of crops. So nothing is from this is available to the farmer. This is not going to go on your farm taxes as a credit. You actually aren't going to be getting anything directly for this. So if your local ethanol plant, you know, like as Brian mentioned, you know, if they're not going to do this, if they're not going to see the value in paying for this traceability, if you know, they're not in an area where people can easily do cover crops, can easily do some of that no-till stuff, if they're not going to be able to source enough volume of this to get the credit themselves, they're probably not going to be willing to pay a premium. If they're not willing to pay a premium, you're not going to be able, even if you are doing these practices, it's probably great for your farm, it's great for the environment, but it's not going to translate into any dollars increase in your profitability for doing these practices through this credit, unless the plant is offering a premium to you. So, you know, be very mindful that if you don't have a market that's going to pay increased costs for this to do this verification, probably not something that's worth it for farmers at this point to get into, because it is going to be a credit that's dependent on those plants, not on you know, what's happening at an individual farm. The other thing we were disappointed, soybean growers were disappointed to see, and I'm sure corn and the other groups too, is a lack of feedstocks. These are the feedstocks that are available in 40B. We're hopeful in 45Z that we get a greater variability of feedstocks. We don't have enough corn oil and enough soybean oil to meet the SAF market if we're going to still meet all of the other markets. If you took the entire production of soybeans in the United States and turn that into SAF, you know, just for example, you know, for 1 gallon of sustainable aviation fuel, you need 9 to 10 pounds of soybean oil. For biodiesel, you only need 7.5 pounds of soybean oil for every gallon. So we can make a lot more biodiesel than we can SAF. We don't have enough soybean oil to make the amount of SAF that we need to run the airline industry. In Minnesota alone, we can run the Delta terminal in Minnesota for about a month and a half if you use the entirety of a year's soybean crop for SAF. So the numbers just aren't there. We're going to need pennycress. We're going to need camelina. We're going to need some of these other feedstocks to be available. And especially in 45Z, if we're going to continue to do the diesel markets and some of these other markets that we've already been providing our biofuels into, if that guidance comes out and is this restrictive, we're not going to get the benefits for farm profitability. We're also not going to get the benefits for climate change. We're not going to meet the goals of using some of these other reduced carbon intensity fuels. You know, as Brian mentioned, the petroleum being 100, and we know ethanol, biodiesel, the SAF from these products are lower than 100. We're not going to get those benefits to the climate if we cut these things out. So I think that now we're ready for the next slide and talking about next steps. You know, we are definitely involved in the 45Z from the soybean side of things, looking at a lot of these issues that we just discussed. You know, there should be, in our viewpoint, ways for farmers to, and for the plants to show that they're reducing a carbon footprint from a variety of different practices. You know, one of the things that the carbon model ignores is the use of these biofuels themselves. And we know in Minnesota, the planting of corn, the planting of soybeans, harvest of corn, harvest of soybeans is done with 20% biodiesel. We know that's cutting carbon. We've seen that happen in Minnesota for 20 years now. That's not one of these pathways that we can reduce the carbon footprint for plants. So there's a huge amount of tools, the climate smart ag tools that farmers could do that could reduce carbon footprint and help the environment. And we need all of those on the table. And it shouldn't be a list of you have to do X, Y, and Z, because that's not how we farm. We don't farm all on the same playing field. You know, Martin County is very different than Polk County, is very different than St. Louis County in the state of Minnesota alone. Very, especially, you know, regardless of getting into Georgia corn versus Minnesota corn, or, you know, Iowa soybeans versus Florida soybeans. It's all very different, and all of those options should be on the table. So that's been the biggest thing for us. I know the other two groups are working on these issues. So I'll turn it over to Amanda.
Yeah, thanks, Joe. Well, and so yeah, as Joe had mentioned, we are anticipating that there is going to be some 45Z guidance that will be forthcoming. But as Brian had kind of mentioned, with the election uncertainty and whether or not sort of these credits might get extended in like a tax package, given the compressed timelines, the election uncertainty could also be impacting the timeline for when this 45Z guidance could be forthcoming. We don't have a good answer for you today on when we expect to sort of see that. What the administration has said is that they were going to put out a request for information, and this would provide an opportunity for public comment. We don't know if they'll still follow that process about looking for this request for information, or if they might do more of like an interim rule before a final rule. There's some competing and different information that's out there. But I do know that all of the associations that are represented on the webinar today are all going to be actively working in this space to make sure that we are providing the input to Treasury and other federal agencies around the development of this 45Z guidance, both doing that at the state, working with our members at the state level, but then also working really closely with each of us who has a national affiliate as well at the federal level to make sure that that is reflected. And as we've talked about, I mean, some of the things that I know that we're all working on too is just on the farm practice side, as Joe had kind of mentioned, really trying to unbundle those three kind of, or those 2 or 3 specific practices under this all or nothing approach, trying to get more agriculture production practices sort of recognized in the model and in the scoring that can help to reduce the carbon intensity of the feedstock. I know I'm from the plant level too, wanting to have more of those technologies that could be reflected in the model to demonstrate different ways and ability for the plants to be able to also reduce carbon intensity inside the fence during the production of the fuel. So as we're encouraging our members to work with us on trying to elevate some of that various farmer or biofuel producer input. We also, for the farm groups, we have a grassroots policy development process that's going to be getting underway. And that is also an opportunity to be able to provide some input on these credits and future credits in this future market for sustainable aviation fuel to make sure that the policy positions that are important to farmers are reflected in those state level policy platforms. So those are probably the main points that I wanted to cover and the kind of what comes next. And we have plenty of time for Q&A, so I'll turn it back over to Ariel.
Fantastic. Well, thank you, Amanda, Brian, and Joe for that. I think a ton of information there. I will encourage folks to put their questions in the chat, or if you would prefer to come off mute and ask your question or give your comment, you can raise your hand using the tools below in the Zoom toolbar there. But I'll kick it off. I think one question, and maybe I'll kick it to Amanda first, is what should farmers be doing right now? We heard Joe talked about some companies are offering to, calculate your CI score acre by acre, and you get to pay for that service. I've also talked to some farmers who are just taking photos of their fields this year and keeping good records on their fertilizer. What would you recommend farmers do now so that no matter what happens, they're well prepared for what's going to shake out?
Yeah, great question. So I think that definitely some of the efforts that are happening around trying to figure out how you're documenting some of the practices, what is happening on your own individual farm, those are important things to be doing. But because we don't have the specifics on the guidance, I guess our overall advice would be to maybe avoid having to sort of, pay or subscribe to having a specific CI score done because it's not quite sure how that's going to be reflected in the guidance that's coming for some of these other tax credits. There is a lot of work too that's happening separately through the USDA Climate Smart Commodities programs too, and that's also a good source of information to kind of get a sense of how some of these different practices are going to be evaluated or used, and looking at ways to reduce carbon intensity or reduce carbon at the farm level. And so exploring some of those different options too could be something that farmers could be looking at. Again, because the way these tax credits are structured, the payment might be coming, there's not going to be a direct payment to the farmer for these types of tax credits. It might come in the form of looking at sort of the contractual arrangement that a farmer might have with wherever they're delivering their feedstock to, whether that be an ethanol plant or a bio processing facility for soybean. There could be a premium that goes into that, but that's also really uncertain because Brian has to, and his members have to figure out sort of what is going to be the ROI for some of those capital improvements that they might need to be making to get under that 50% CI score or 50 CI score. And then if there's going to be enough value in those incremental changes or incremental reductions through the credits that offer a little bit of an extra bump if you get even below that 50 CI score. And I know Joe and Brian probably have more to offer in this question as well.
Yeah, Joe?
Yeah, I think for the soybean farmers that we've been talking to is it is very hard right now without the biggest thing with the soybean industry is the traceability. It's not like you're taking your soybeans to a biodiesel plant and they're using it like an ethanol plant. The traceability is a lot harder. You have biodiesel plants that are buying soybean oil from here and this from there and this from there, and the traceability is going to be something they're going to have to work out and figure out, those producers. And what's going to be acceptable to the IRS is still not greatly known. So what the records the farmers are doing, if they're coming up with elaborate records on their own and handing it off, that may not be approved, it may not be accepted. And so just being very careful with it right now is our advice. But I wouldn't, at the same time, I tell them not to get discouraged by or, turned off by some of these practices, because the cover crops, reducing your, obviously for corn, reducing your fertilizer usage reduces your cost, could help increase your profit. You could have some benefits from cover crops, benefits from some of these other things, even if they're not included now that we're trying to get included in 45Z, that could have other benefits to your farm and those benefits to the climate. So, really making it more about looking at still what's doing the best for your farm and not getting caught up in any kind of hype about money flowing to this, because there's just not money flowing to farmers at this point on these things.
Mm-hmm. And Brian, I'll ask the same question to you of what should farmers be doing, but also maybe add a little, because I know I've been on some other webinars and discussions about this that say, go when you deliver your corn to the ethanol plant, ask the people there about what they're going to do about 45Z. And so, hopefully that's in a way that is conversational and not demanding. But any advice on what farmers should be doing in terms of qualifying for this potentially, and then also engaging with their local ethanol plants as this continues to roll out?
Yeah, no, I think Amanda really hit the nail on the head. It's one of these things that, I'll just reiterate, there's not going to be a premium or a payment unless the plant gets below that threshold to qualify for a tax credit. So, how that credit, if the plant qualifies for it, how that flows through the value chain is still, I think, very unclear and uncertain. I think for a lot of the cooperative ethanol plants, whether that's a dividend that goes directly back to the members of that cooperative, or whether it's a premium on the corn that is delivered, the climate smart corn that is delivered to that plant. I think there are a lot of different ways that could be structured, but that's going to be, I think, on a plant by plant basis to determine if they qualify for the credit, how they want to share that credit with the feedstock growers themselves. But I think, to Amanda's point, there are going to be some significant capital requirements at the plant level to actually get the CI score under that 50 threshold. So I guess it's still pretty uncertain. Okay, to what extent will a plant qualify for a credit? How much will that credit be based on the life cycle analysis? And then how much is going to be left over after some of that, after some of those capital requirements that are going to be necessary to get that CI score below 50. So yeah, I'll just kind of reiterate what everybody else has said. We're in a really kind of uncertain moment right now. And I think until we see more guidance from the Treasury Department, until the plants can kind of grasp what is the return on investment going to be if I get my CI score below 50, it's really just hard to know at this point.
Yeah, great. We do have a question in the chat about, is the carbon market really happening now? And is that more promising than this IRA credit program? And maybe I'll take the first crack at that and then see who else would like to respond. But, you know, the way that I sort of look at all these different opportunities for farmers to be rewarded for their practices that have climate benefits is, you know, there's a number of different pathways, and you really, as a farmer, need to figure out what the goals of your farm are and which program or pathway fits best for those goals. So I always like to bring in the idea that direct marketing and things like organic labeling or non-GMO, things that are traceable and identity preserved, those markets are a premium market for the way that you're producing your crop. And so I think that's part of this space. Then you also have the carbon offset market, where you're selling the carbon that you're sequestering in your soil or in your forests or however you're doing that. And those have specific rules associated with voluntary offset markets that are pretty well established at this point from the private sector. It's not a regulatory market, but the private sector has sort of been coalescing around some guidelines for those voluntary markets that guide those offsets. And then you have this whole world of supply chain programs. So companies like PepsiCo and Walmart have made these commitments to reduce their greenhouse gas emissions within their supply chains. And they're working directly with farmers through sometimes partners, nonprofits in the area, SWCDs even, and doing things like cost share on cover crop or reduced tillage, technical assistance, things like that. Or sometimes we're starting to see more premium prices for grain delivered that's grown with climate smart practices. I saw there's a new whiskey, I think, on the market that is grown climate smart. And so that's one of these supply chain programs. And then you have these fuel markets, and they're developing both out of these IRA tax credits as well as the low carbon fuel standards that are in the West Coast states and New Mexico. And I think it'll be interesting too to see how those the fuel demand for low carbon intensity fuel is driven both by these tax credits as well as those supply chain programs, because a company like Walmart or Amazon has both, you know, a greenhouse gas emission associated with the agricultural products that they're buying, as well as the transportation that they're using to ship those things. And so they may start looking at low carbon intensity fuel that is separate from the tax credit that has a value to them. So long answer to the question, but I think that the answer is, like, it's really complicated right now, but there's a lot of different opportunities. And so navigating that is difficult, but I think that's where all of our associations are trying to help to add some clarity to the mix and to influence how those markets are developing. We're getting some more questions. I'll see if Joe, Brian, or Amanda want to add anything on that one before I get to the next one in the chat.
No, I think you did a great job kind of explaining sort of all the different options that are out there. And I think that, you know, what farmers are looking at too, especially that are being approached by some of the companies through some of these third-party offsets or whatever that might be, those supply chain type of programs, you know, because there is a cost that a farmer has when they're looking at either changing a tillage practice or adding cover crops or whatever the practice might be. And so I think a lot of farmers are trying to figure out to balance, is there going to be enough value in that credit or what's being offered through those voluntary programs to be able to make economic sense on the farm, to be able to cover some of those costs for the establishment and the maintenance of that practice is another piece that a lot of farmers are really looking at. And so far, I think that struggling and trying to have some of the numbers kind of really cover a little bit, or to recoup some of that investment in that practice change. And so really wanted making sure that the value of those credits, as much as possible, are getting back to the farms, to be able to offer that incentive and recoupment of investment, because there will be, if the company is marketing a product as climate smart, and if they're getting enough value out of that with their customers, really making sure that that value is getting back to the farm, and that there's also really a lot of value in the data that farmers have, and really wanting to make sure that they're protective of some of their data, because there's a lot of value to that data as well.
I would just throw into, the carbon markets really started in 1997 with the Kyoto Protocol. That was kind of where they first were all created, full effect in 2005. And they didn't start in ag. They started in other different things, whether it was, you saw some cap and trade programs in the Northeast. You saw some other carbon programs where people were reducing their carbon so that other people could keep producing carbon that they needed to. And all those markets have failed, and they've all kind of crumbled in and upon themselves. So I don't see long term. I think it's really important that, like as Amanda said, you're looking at what you need to do for your farm, making sure your soil's healthy, making sure your farm practices are the best for what you're doing, because long term, that's going to be the profitability. It's not going to be a carbon market or that kind of thing. It may have some benefits to your individual farm, but if wholesale changes to your farm just to take advantage of this, might do more damage in the long term, especially since some of the fuel markets where they're heavily regulated, like CARB, the California Air Resources Board, and their transportation fuel standards in California. The carbon market is very robust and going very strong, but you see some of these voluntary markets that were hot and the next big thing about 3 years ago that are now kind of puttering out. And I'm not to say that they're all bad. I think some of these definitely have good goals, but long term, just making sure what's good for your farm and good for your soil is probably the best thing for farmers to do.
Yeah, absolutely. And not the topic of today's webinar, but voluntary carbon markets in agriculture are a hot topic, and USDA is currently asking for public comment on some of their new guidelines. Minnesota Farmers Union about a year ago published a farmer's guide to carbon market contracts in Minnesota, and I think my colleague Stu might have that link ready to throw in the chat for me. And we'll be submitting comment about carbon markets and how to make sure they're fair to farmers, so that the value is getting back to farmers, and that that this is actually a fair deal. So there's that link. Brian, there's a question in the chat for you about what kind of logistics would need to take place at ethanol plants to keep SAF feedstock, fuel, et cetera, to comply with tax credit requirements, and will plants want to make that investment? And I'm guessing that's sort of a question about, can you do segregated supply? And I'll just add complexity to the question, which is my understanding is that all these calculations about carbon intensity will be on a weighted average annually, but I guess I don't know if that's true. And that probably links to this idea of, could you have a tank for climate smart, low CI ethanol and a tank for regular?
Yeah, I think this is a great question, and it's one that we are wrestling with in the 40B guidance, and trying to figure out what is a more workable approach for 45Z, because the idea that an ethanol plant is going to segregate climate smart corn from non-climate smart corn and process climate smart ethanol on one day and then process non-climate smart ethanol the next day, it's not a feasible thing. The amount of corn that an ethanol plant is taking in on a yearly basis, it's just not logistically, it's not something that they can feasibly segregate the feedstock based on its environmental attributes. So the 40B, we do have questions about, I'll call it chain of custody. So in the 40B guidance, it requires the SAF producer to contract with a feedstock grower. But some of our question is, okay, well, if ethanol is a intermediate feedstock for SAF, then what role will the ethanol plant play in that chain of custody? Will the farmer have to sign a separate contract with an ethanol producer as well as the SAF producer? Who's going to have to do all the certificates and tracking and traceability? Will it be the ethanol plant or the SAF plant? So I think these are all questions that we have and concerns we have with the 40B guidance, because it's really not clear who's going to be in charge of a lot of those certification and record keeping. But I'll say the 40B guidance does allow for, it's this thing, we call it mass balancing, where essentially you don't have to segregate the feedstock. But that does, I would say, pass the buck along to the grower themselves. So while the ethanol plant might not have to segregate the feedstock, the grower might be the one that has to, decide how they're storing climate smart agriculture feedstock versus non-climate smart agriculture feedstock. So these are all questions. I think for 45Z, we are working on providing some comments about how we can better structure a system. Because I think one of the concerns with 40B is and how it handles the climate smart agricultural pilot program is it really, to Joe's point, the way that they structured it might be more based on politics rather than the realities of how grain travels from cooperatives to elevators. So it is one concern, and one of the things we're thinking through and with some of our national trade associations is maybe there's a financial product that is separate from the grain itself, where the attribute of that grain is assigned something like a number, and then that's maybe traded on a separate market rather than having the attribute of that grain travel with the grain itself. So these are all questions that I think we're trying to wrap our mind around, because these are tough questions. It's the first time we're trying to incorporate environmental attributes in a feedstock into the fuel production process. So these are, there's a lot of logistical issues that I think we're still trying to wrap our minds around and figure out how exactly it's all going to work.
Yeah, and I would just tack on the biggest, I was just at a conference with the Department of Energy in the SAF hub in Minneapolis. And for the end users of these fuels, there are other, they talked about some of this next generation, the second generation, that the biofuels, our feedstocks are kind of, they call them the first generation of going into SAF, and that they're lower. And there might be some second generation things that are better. And I think we see a lot of times, whether it's electric cars and ethanol or, biodiesel and electric trucks, there's a rush with some of these policies to get to the best and ignore the better. But right now, the cost effectiveness of this is got to be key if we're going to get to be using lower carbon sustainable aviation fuel. If we make it too expensive for the plants, too expensive for the farmers to do, make the feedstocks too expensive, we're not going to get these products into that airplane to burn cleaner, to get the climate benefits that we need. They may not be the best climate benefits, but they're better than petroleum. If we don't have these things be cost effective, the airlines aren't going to flip over from petroleum. So these extra costs, I don't think, are always added in by some of the environmental groups pushing for some of this thing. They talked about one of the things they were very excited about was a pathway to make SAF out of carbon dioxide. And they were very excited about, all the environmental groups were very excited about direct air capture in direct air capturing carbon. None of the places that are making that path, or that looking at that, they're all looking at ethanol plants. That's the cheapest, easiest way for them to get the CO2. That's where they're going to get it from. Direct air capture is going to make a sustainable aviation fuel that's 5 times the cost of petroleum. The airlines just aren't going to use it. So, making sure that we're out there saying, farmers, we understand there may be something better, but for right now, we're better than petroleum. And we shouldn't slow down the adoption of these fuels to try to get to best.
Wise words. Well, we are at our hour, and which went by quickly, it felt. I want to really thank Amanda, Brian, and Joe for all of the expertise that you've all shared and for your partnership on this. If I can summarize some of the things that I think I'm taking away from this, there's a lot we don't know still. And so, there's a lot of learning we have to do together, but there's still opportunity to shape the future of these tax credits, particularly 45Z. And the way to do that is to get involved in your farm organization or association. So some great resources on this call. And Harmon put this in the chat, and I think it's absolutely right that this is a great time for farmers to try things out and find out what works for your operation, and then find a program that fits for you. So lots of exciting times ahead. We will put this recording up on our Farmers Union YouTube channel and share it out with folks who are on this call and on our social channels and elsewhere. And I maybe will take the prerogative to commit this group to hosting another webinar when we do know more about 45Z, and we can do the same sort of little walkthrough on those rules when they come out. So stay tuned, and thank you all so much for taking the time to join us this morning. Really appreciate it. Thanks, everybody.
Thank you.